Good morning and good afternoon, ladies and gentlemen. Welcome to the 44th housing market update that used to be called the COVID webinar. And we are thrilled to have you with us here today. And I wanted to let you know there's a new thing happening. After 4 years and 44 get-togethers, we are now shifting what we do as the housing market update to a subscription product. And after 4 years of this and providing it to you guys, it was just time for us to grow up a little bit, to expand, and we hope you're going to be part of the journey with us. The concept is that every 4 to 6 weeks, you'll be getting material that's very similar to what we'll be talking about today. But there's additional research. There's quick hits we'll be sending out. There's a few things a month that you'll be getting that is intel on the market that's going to keep you up to date, even more so than just what our HMUs do right now. So we hope you will join us. And as part of that, you to know that we're now expanding our research to include a national outlook. And the important thing here is that we're driven by Ali and the team with the economics team. We are looking at the nation and then breaking out marketplaces and trying to get a little bit more granular. Again, also real time to help you make good decisions and know what the heck is going on. And speaking of knowing what the heck is going on, we now have released Enterprise 4.0. And of course, I think you know Enterprise is our basic database. But when I say basic, I mean basic to any decision you have to make. And it's got the deed information in it, closing, detailed property profiles, all information about actively selling subdivisions. We'd love to have you guys take a look at it if you're not currently subscribing. And the big news for us, and this really is big news, is that we have purchased and brought in BDX into our family. And we are merging the two companies. So the concept here is that we're now making a full feedback loop where we've got the information that's coming from home shoppers through BDX, and we'll be making the Zonda information available to the consumer. So think of it as a full loop, B to C, back to B, back to C. And we're excited. The BDX team is integrating with us, terrific people. We've worked together now for about 10 or 12 years, but now it's formal. We're all part of the same family, and we are fired up. And note that there's still opportunities for you to get online and get a quick market snapshot on any of the markets you like. Get online, request the snapshot. We'll give you insights on any MSA that you are interested in, and we will send it to you. Now, today we are thrilled to say that we've got two very exceptional sponsors. And the first is Propane Energy for Everyone. That's the Propane Education Research Council. You probably have met them at many industry events, including ours. And of course, why propane? It's clean, it's reliable, it's stored on site. It gives flexibility to a builder or to an owner, and ultimately it powers the independence of natural gas lines and the electric grid. So thank you to the Propane Education Research Council. You guys are great partners. We've always appreciated you. And when you think about it, look at the left-hand side of this. Space heating, water heating, cooking, clothes drying, fireplaces, standby generators. Learn about the latest trends, but propane is here to stay, and boy, oh boy, is it useful. So check it out. And again, we thank them. Now, our second, and also grateful to have sponsor, check out this really cool setup, the next generation of garage door openers. And of course, we're talking about LiftMaster. And they're the leader in smart garage solutions. Look across this. They've ultimately got over 10 million users. And they've got a wide range of partnerships. Please check them out because their collaborations, like the ones with us, are long-term. We appreciate them greatly. Look across the bottom. You can see some of the places that you can find LiftMaster. And once again, to LiftMaster, we are grateful and thank you for being with us today. All right, let's dive into it. So for those of you who have been with us all 44 times, I say thank you. And as always, you can see where our agenda is. We're going to go through a whole series of elements and end with final thoughts. But to kick it off, I'm going to welcome to the virtual stage our chief economist, Ali Wolf. And one of the ways that I would define Ali is in one word. It's trust. And it's over the 10 or 12 years that we've known each other and the 7 or 8 years that we've worked together. Ali covers a lot of ground for our organization, and she works across the country. And in fact, she and I are going to be in Seattle together for our deal makers later today and tomorrow. But the important thing is what she brings to us when she's traveling, when she's meeting with many of you out there, is that she reverts back to us with knowledge and insights on the issues in the market, and we do research from this. And she makes our team smarter. I can speak personally. She's always made me smarter. And we just greatly trust that she's a leader in our thought processes. But secondly, on a personal basis, I trust her because Allie is the perfect partner. Allie steps up whenever it's needed, and sometimes when she's not needed, because she knows help is required. And boy, oh boy, Allie, all I can say is thank you. But last but not least, let me also just give you a quick example of this. The shining example is the way the President's Council of Economic Advisors now looks at Allie. And just last week, they reached out to her with a fact sheet before President Biden had his State of the Union. And there was a series of facts that they wanted to have Allie check, and also questions that they wanted from her to pose to the president. And if that's not an example of a deep trust in the industry, I'm not sure what is. So I trust you're going to love what you hear from Allie today. And with that, ladies and gentlemen, our chief economist, Allie Wolf. Allie, take it away.
Awesome. Thank you, Tim, so much. And hi, everyone. We're so delighted you're here for our 44th webinar. Now, I want to reiterate some of the things that Tim said about the National Outlook. If this is new to you, just so you know, the National Outlook is our published research subscription. That's all things economy, policy, demographics. This webinar will now go to our subscribers only. What also you'll get, as the client Tim said, is a report every 4 to 6 weeks. We have custom research articles, quick hits, data downloads. So we hope that many of you will carry on this journey with us as a subscriber to the National Outlook, and then you can continue to get this content that we've been giving away for the past 4 years. I can't believe it's been that long. Now, where I want to start with today's actual presentation is talking about this interconnectivity between the existing home market and the new home market. What we know is there's been this funneling effect. It's really well understood at this point of people coming into the new home space because, in part, the lack of resale inventory. And that's where I wanted to start. We often like to look at this active listings number, can show us by month, by year, the current trends. For 2024, both January and February were at the highest level since 2020. The February active listings number came in 15% above where we were last year. Where this leaves us is still down 40% compared to 2019. And when we look at this across market, most areas following that same trend. If you're in LA, DC, Las Vegas, you're looking at inventory down 50 to 60% compared to those 2019 levels. San Antonio, Austin, these markets have been kind of going above and below 2019 levels depending on the month, really for the past 6 months. The February data does solidify the total active listings above 2019. Now, we like to look at 2019, as most of you know, because it gives us a bit more of a normal market comparison. But we also like to look at the data compared to last year. Where are we seeing notable shifts that we need to start to track? Well, hear what you're finding. Your eyes are probably like mine. They head over to Las Vegas. Vegas down 40% year over year. By the way, when we look at our market rankings, Las Vegas is one of the significantly overperforming markets on the new home side. When you look at where we've seen the biggest increase year over year, it's Orlando, Tampa, Denver, San Antonio, Dallas, Jacksonville, Houston. So you basically see this concentration of markets in Texas and Florida that have outperformed the national average with this increase in listings. Remember, it's compared to last year, not compared to 2019. But when you see this kind of concentration, you really have to ask yourself, why? Why are we seeing this lift? And we attribute it to a handful of things, a couple of them bad, a couple of them good. Now, part of it, and going to the bad first, has to do with in select markets, some of the insurance costs, the renewals that are coming in, the higher property tax bills, each of those causing some people to evaluate where they live. But we also think on the good side, Tim will show later starts activity by metro, Texas and Florida, top production markets. Think about one of the big issues in the market has been that existing homeowners feel like there's nowhere else for them to move. They feel stuck. And I think in some of these markets, they feel a little bit less stuck because there is more competition. There's a little bit more optionality. But as you look at this, why we should care is we should ask ourselves, have we then seen an accompanying change in the new home market in response to seeing listings rise? Now, a very simplistic way that we can try to draw that link is by looking at our ZMR, the Zonda market ranking. Most of you know about this. This is where we look at markets across the country and quantitatively assign a ranking. Well, nationally, the market came in as average for January. Any of the yellow dots are right in line with the national average. The green dots are among the 46% of top markets that are overperforming. But let's go back to that question of seeing that change in listings in Texas and Florida. How have we seen then the ZMR in those markets evolve? So we're comparing out last year to today, and actually most markets are either the same as they were last year or performing better, which really goes back to a key question we've been asking ourselves. Is more inventory good or bad when you think about the new home market? And we think the idea of inventory being bad comes with an increase in investors selling their homes or an increase in distressed homeowners needing to sell their home. But we look at more inventory oftentimes as good because, yes, more competition, but also more mobility. We're going to continue to watch these markets, though, watch the trends really over the next few months, but also over the next year, because I think time will really tell us if we start to see this pooling from the new home market. For us, as we think about the next few months in particular, we're going to keep some select markets in Texas and Florida on our watch list to just see if it continues to move in this path where we're not seeing any kind of massive slowdown because of the change in resale supply. But let's go back to this chart. So we looked at active listings and we said, okay, January, February, highest level since 2020. Let's now run some scenarios. Let's say that we saw inventory nationally rise 10% from where they are today. That's what this dotted line is showing. What if we see inventory levels rise 20%, 30%, 40%? It's at the 40% increase that we see active listings get back to where we were in January and February of 2020, when you see a 50% increase that gets us back to 2018 levels. Okay, so we would need to see a pretty big system-wide shift to see this kind of increase. We are seeing big increases on the metro level, but now we're talking about the whole market in general. But let's tie to why we care. When we look at the new home market, we know that the new home has represented 30% of inventory. This is a really well understood stat at this point. But all else equal, let's then do that assumption again. What happens if that existing home inventory goes up by 10%? What if it goes up by 30%? What if it goes up by 50%? The dotted line shows you where the new home share of total inventory would fall. So even with a 50% increase in resale inventory, we would still find that the new home share of the overall market would still be elevated compared to what we've seen historically. It's not to say we don't need to worry about changes in resale, because of course it's going to impact dynamics, but I think that made me feel a little bit more comfortable about the trajectory that the new home market is on. Now, we know that there were, if you think back to the ZMR map, pretty clear differences in relative strength and weakness of the housing market depending on location. But we've also uncovered really interesting trends when it comes to price point. Now, this is showing you a chart that some of you may recognize. This is where we look at the average sales rate per month per community at a new home community, looking at the entry-level market versus move up versus high end. Think of it as bottom third, middle third, top third. Now, this upside down pyramid shape is standard. This is what you almost always see, because at entry level, when you have the lower price points, you have a larger buyer pool. It just makes sense. But what we noticed is if you look at these three categories relative to themselves, entry level, the average sales rate for entry level has gone up 20% compared to pre-pandemic. which sounds good until you hear that the move-up market relative to itself has gone up 40%, and the high end has gone up 35%. In fact, what we're capturing is that the entry level is now the slowest group relative to itself. And over the years, we've spent time talking about why high income, job growth, equity building in a home, wealth, life stage changes, migration. There's lots of reasons why we've seen a bit of this outperformance in the move up in high end markets. And we've talked a lot about if you're buying off of income and you're trying to make sense of interest rates and you're trying to make sense of home prices, it's a lot harder than it's been in the past. In fact, I wanted to show some Zonda data to really hit this point home. So look at the beginning of this chart, 2018. In 2018, when you would look at the volume of sales activity by price point, which also is in effect a proxy of supply availability as well, what we saw is that the $300,000 to $400,000 price point and the $200,000 to $300,000 price point, those were our two highest share of overall activity. Now, as we see how this has evolved, in the most recent data set, what we're finding is a tie at that $300,000 to $400,000 price point and that $500,000 to $750,000 price point. What used to be, I would call that traditional entry level, the bottom part of the market, 200 to 300,000 used to represent 25% of total contracts. Today, we're down to less than 10. In fact, if you look at how the data has clustered, we're just finding that a lot of the areas across the country that used to be very traditionally affordable and attainable have gone up in price in general. The $400,000 to $750,000 price point in the US market right now makes up 80% of total volume. That was 60% in 2018. So we've seen this cluster of the price points. What this has done is, yes, we understand why. We've spent years talking about all the different factors that have pushed prices up, but this has also contributed to a flip in the top buyers. If you remember last time we met, we talked about how millennials were the most active buyers up until last year, where boomers overtook them. What I want to do in this section is talk about two groups that we covered last time we met. I want to talk a little bit more about millennials. Even if you're sick of them, I can tell you why they matter for the housing market. And I want to talk about those single female buyers a little bit more. So let's start with the millennials, and let me tell you why, if you're sick of it, why you should care. We know that millennials are the largest living generation. We know that we have a mix of first-time buyers and existing homeowners. This is showing you the millennial homeownership rate by market. We know that millennials have been able to increase their homeownership rate since the beginning of the pandemic. But what we also see is they are the largest living generation, but they are below all of the other cohorts in terms of overall homeownership. 35 to 40, you can see where that falls, under 35. So still a lot of opportunity here. Instead of focusing exclusively on the move-up buyers like we've done recently, the move-up buyers that have a life stage change, that have equity, that have been able to contribute at the higher price points, I want to talk a bit more about those millennials that are renting, that are our first-time buyers. And the first thing we know is we've done our millennial survey for 7 years in a row, and every single year we find that 95% at least of millennials want to own a home one day if they haven't already purchased. And this is from our most recent data. I thank many of you that filled out our millennial survey and helped us get the word out. We captured this at the end of last year, beginning of this year, where we've seen a pretty big uptick in respondents that plan to buy a home in the next 1 to 5 years. And you can see the highest concentration of these millennials, the largest group of our entire country, want to buy homes over the next 1 to 3 years. And we look at why they haven't purchased, and there will be no surprise whatsoever when the number one, the number two, and the number three reasons why they're renting comes down to prices, affordability in general. But what I thought was interesting is to compare out the reasons for renting when we collected this data at the end of 22 versus the end of 23. Notice the mint, which was 2022. We know what was happening in the housing market in 2022. The market was changing very dramatically. And we had a majority of millennials that were saying they were waiting for prices to come down before they entered the market. That has pulled back really down to under 40%. And I attribute this to the idea that people feel a little bit more stable, a bit more comfortable about where the market is. But it doesn't change the fact that they're still trying to figure out how the heck can they make buying a home make sense. And this is where savings has come in. We know that for a while, the fact that we had the student loan forbearance and the federal stimulus that allowed for this increased savings rate. Now what we're finding nationally from the personal savings rate is we're below pre-pandemic times. That matches what we captured in our millennial survey, where now we're at about 50-50 of millennials that said they saved more money compared to the prior year. So savings becomes important because that's one of the big hurdles, is being able to come up with money for a down payment. So we then said to the millennials, okay, if you save more money, what did you do with it? Now, we know housing has benefited from two of these answers. I've used it for a down payment on a home. I've used it to remodel my home. Todd Tamilak, you guys know, he's our building product expert, looks at this as the golden decade for remodeling because of the age of housing stock and the fact that a lot of the younger folks are willing to take a home that maybe needs some remodeling. But when I look at this, those are the two direct impacts on the housing market. But there's also three that I would say have pretty strong indirect impacts on housing, which is for other things that people did with their savings is they used it to buy stocks and investments. They're saving as much as they can, and they're paying down debt. All three of those to me feels like it's getting people on the right path to maybe hit their timeline of being able to buy that home over the next 1 to 5 years. But let's then go back to millennials of all groups, whether they own or whether they rent. What we wanted to understand is, in order to purchase either their first home or their next home, what are they willing to do? Well, the number one answer here is explore different neighborhoods. And this hits absolute home for me. My husband and I, we had our first home in a really great part of town. We wanted to move up within that same part of town. The numbers did not work. We could not afford. And we kept trying and trying for 6 months, and then finally said, you know what? If we want to buy a move up home, we need to expand our search radius. And that's where we were ultimately able to find our move up. So we know that at a certain point, people may have to compromise on exact location or exact needs. The second highest response is that people are willing to put more money down. Again, this can tie into savings, but I think that this will also be really impactful for some of the consumers that have the bank of mom and dad, and that maybe someone can help them come up with a little bit more. But then our third highest response is look at a smaller home. And this is where we see a direct alignment with what we're seeing in the new home market. We talk to builders and we say, okay, what changes are you doing to your product to lower cost and sales price? And the number one response at almost 50% is we are looking to build smaller homes. We capture that exactly in our Zonda data. When you look at the national unit size, what we're finding is that home sizes are down 10% compared to 2019 nationally. That ranges from about flat in Miami and Sacramento to down about 20% in places like Charlotte and Seattle. So we know for the millennials, it's kind of thinking through what compromises are being made, what really matters to them as that key driver as we think about that demographic tailwind that we continue to have moving the industry forward over the next handful of years. But I also wanted to spend a little bit of time talking about the single women buyer, because we talked about them last time, but I only talked about it briefly. I had shown this chart, which is from the NAR, and it shows us the composition of home buyers by age and then by status. We had said, okay, married couples are the most active. Behind them, though, are single women. In fact, we were on Good Morning America talking about the single women buyers in today's market. And when I prepped for that interview, I pulled up lots of different data sets that I thought was worth highlighting here. Because if you look at the composition, the historical composition of home buyers, what we find is that married couples, yep, by a long shot, the largest share, but look at that pretty notable drop down. And if you look at the other cohorts, this is tracking from 1980 up until current. We've seen that single women have moved from about 10% of the market to 20% of the market in 40 years. They've doubled their share, where at the same time, single males had been at 10% and continue to be at 10%. Now, to me, then this begs the question, okay, if we know that this is an important buyer cohort in the market, where are we finding single females are buying the most and why? What matters the most to them? This is tracking out the homeownership rate by market for single females versus single males. The numbers that you see will be the spread between the two of them. I was actually very surprised to see Miami come in at number 1. Then you have Tampa, Baltimore, Philadelphia, DC. So just looking at the top 5, a concentration in Florida and in the Northeast. But let's talk about these women. What do we know about when they're buying homes? What do we know about their characteristics? Well, compared to single men, for example, single women are more likely to be parents and or more likely to be caretakers. And so by extension, we find that single women are more likely to live in suburban areas, which we think ties down to maybe they have school-age kids where they want to have a good school district. Single women are also more likely than the other cohorts to live in multi-generational units, which I think also ties down to the caretaker point. When we talk to consumers in general, we know that the preference is a single family detached home, but for single women, they are more likely than the other cohorts to reside in an attached home. And I think part of that comes down to this idea of lock and leave. You can get into a community that has an HOA that can help with some of the maintenance. There's enough else going on in life, an attached home can make sense. What we also know is that single women are more likely to buy homes than men, I think partly because women are less likely to engage in high-risk investments. When you look at day trading, for example, we know men make up 90% of all of the day traders, women make up 10%. Besides investing in a 401k or in bonds, where else do we want to build our wealth? And I think that this ties back to single women saying, okay, I can build my wealth by owning my home. Safety, security, big important parts. That's why sometimes gated communities makes more sense, or really looking for areas that have a relatively low crime rate. And then this last point, which I think applies to most groups, will be just this idea of stability and personal space. But if you think about a single female and just all of the expenses of running your life, locking the largest part of your monthly budget is a really big driver for why we've seen these women purchase homes as well. Now, I want to go through my final section here, which we're calling food for thought. And what you need to know about this section is I'm going to go through 3 things: incentives and housing market strength, all-in housing cost, and economic predictions. Each of these sections will be quick hits. Each of these sections will have 1 to 2 slides, and depending on the section, there's going to be varying levels of conclusions. For example, the first one, I'm not really going to give you a conclusion, just something to think about. And then the next 2 are a little bit more conclusive. So let me go back to the ZMR. We showed this earlier, looking at the relative strength of different markets across the country. But now what I've done is added in parentheses the percent of projects that are offering incentives. So take a look up at Seattle. It says 59%. That means 59% of markets in Seattle of new home communities in Seattle are offering incentives. Now, the reason I want to show this is Tim and I were at a conference last week where there was an interesting comment that was brought up, which was, we're celebrating that the 2024 housing market looks healthy and that things are going well, but to secure a home, it's costing a lot of money. We're having to use a lot of incentives, the mortgage rate buydowns, the funds towards closing costs. And in some markets and at some price points, we're not finding that homes are just flying off the shelves. And the question was really posed, how strong then really is the market when we're using these incentives and we're really having to work hard to get someone to buy a home? To me, what this reiterates is what we talked about last time we met, which was we know that relative affordability is the key problem that's going to be with us, I would say borderline indefinitely in the housing market as we think about the demographics and as we think about how tight land and lot supply is. So again, this one is food for thought. There's not a conclusion, but it's just kind of to think about the state of the market and where you think it really is. The second thing I wanted to cover, though, is what we have called the all-in housing payment. Now, let me tell you about this. So Jeff Myers is our CEO. He also spends time going to different markets across the country. Jeff likes to go to new home communities. And what he started to notice is he would go to different markets and he would find, okay, the base price is the same, but the size of home that you would get would vary and the all-in cost would vary depending on where you are. I'll give more specifics to that in just a moment. So that got us thinking. Okay, if someone is looking to move somewhere across the country and affordability is their biggest thing, they're probably going to start looking by where can I find the lowest price? I'm going to show you a case study of 10 markets. We have this for way more markets. We just did 10 for simplicity. So this is showing you metros, the top 10 in our case study, where we rank them by just price. Someone is looking for price. They find the best price in Houston and Indianapolis. They find the worst price in Salt Lake City and Denver. Now, put simply, they're looking at Texas and they're looking at the Midwest versus the Mountain West if price matters most. But what we think is unfair about just looking at price is it doesn't account for other costs of homeownership, including property taxes. Rocket Mortgage, when they just look at a state estimate, they find that it ranges from about 0.3% to 2.5% for property taxes. We know, and for our assumptions here, we had to make a metro level estimate. We know it becomes more localized than that. A big shout out to Nick Schoolis, who was able to run all of this analysis in the econ department. We then wanted to look at utility bills. We know that utility bills will vary by location, but I'd say more importantly for the new home market, you see a big gap between utility bills from existing homes versus new, meaning new homes more energy efficient, energy bills in general down. We also wanted to include homeowners insurance, which I talked about earlier as it relates to listings. Before I move on, I'd be remiss to not thank Westwood Insurance Agency and Certainty Home Lending. Because when we were putting together this, we didn't have all of the data that we needed. Westwood Insurance Agency and Certainty Home Lending were able to fill in the gaps so we could give you this analysis. So homeowners insurance, we know, has become a very big topic of discussion. So then what we wanted to do was take those three components and create now a all-in payment. So instead of just looking at price, what happens when we include other costs of homeownership? Well, we found that Indianapolis became more affordable relative to other markets. Charlotte became more affordable. Phoenix, more affordable. Orlando, which at first surprised me, but then I thought about homeowners insurance, and you're not going to have the really high homeowners insurance in Orlando versus some of the more coastal areas. Where we did see the loss would be Houston and Dallas, where they went up in the overall rank. Now, specifically, when we look at this, though, I know some of you will say, oh, but there's other tax incentives in Texas that could offset this. I hear that, but I also want to say that as we looked at the insurance costs, we did find the highest insurance costs were in both California and in Texas. We just don't have a California market here in the analysis. When we looked at this data, though, we found two big conclusions. It's not just looking at the shift in rankings. It was two big things that I think the new home market needs to play up. The first was, as we looked at the markets, the new home relative to existing was 17% more expensive by price in our select markets. When we included the all-in housing cost, that premium went down to just 11%. That's partly because of the savings in utility. That's also because of the savings in insurance cost. We found that the average insurance on an existing home in our coverage area was 70% more expensive than new homes. So when I presented this, I met with a builder's team recently, and I had one of the division heads say, well, we're not really talking about insurance costs in our market. That's an important point. This won't apply to every market evenly. We know some areas have those higher insurance costs, but if you are in one of those markets, these are a couple interesting data points that can maybe help build the case beyond the fact that new is brand new. You don't need to remodel it. You're not going to have as much maintenance, and you can probably customize it as well. The final thing that I want to go through here on our food for thought section will be our economic predictions. So our subscribers to the National Outlook have already seen these. What we did is not only came up with statements, thank you, Todd Tamalek, for coming up with these. We came up with probabilities of how likely we think different situations might happen in the economy throughout this year and going into next year. And most importantly, we said, okay, if we're giving a probability of 75%, this is why we believe that to be the case, but this is what could make us wrong. This is what could make the answer be more dramatic than what we said or less dramatic. And again, if you've been a loyal listener, none of these will surprise you, where we do think mortgage rates more likely to be down than up, led by the narrowing of the spread between the 10-year Treasury yield and the 30-year fixed rate mortgage, and by the Federal Reserve cutting rates, though we don't think that happens soon. We've said for a while that we think it'll be the second half of the year. Yesterday's inflation report definitely reinforced that point, where the Fed probably wants to keep taking in new information until they feel very comfortable with their decision. Finally, as you guys know, still a little bit of a nervous Nelly when it comes to the economy. We're just seeing some cracks. We've talked about the cracks on the consumer side before. We know that there are some cracks coming out in the office space. So not fully ready to say game over and everything is great from the economic point of view, still tracking some of those key trends and how they've shifted in the market. Now, with that, I would like to bring back in Tim Sullivan, our Chief Advisory Officer, to go through his section. And for his introduction, I want to actually spend some time reflecting on the past 4 years of working specifically with him on this housing market update and some things that I've learned. Now, they are going to be cliches, but I think that they're worth people hearing just as broad life lessons. These are the 5 things that I've learned from Tim as we've been working through these webinars. And the first is, don't take yourself too seriously. For any of you that know me, this hurts so much. I just take myself way too seriously. But working with Tim, his improv history, I think it's really helped me get more comfortable trying to loosen up, trying to have more fun with the work. You have to protect your mental health. So Tim was already in San Antonio this week. I've already been in Tucson this week. We're both heading off to Seattle right after this. While we put work as a big priority, we really care what's happening in the market. Tim has reinforced the idea of spending time with family, travel, enjoy hobbies. Life is too short. We need to, all of us, this is not just for me, to remember to protect our mental health. Always, always, always give context. I've learned this from Tim. He has reinforced it over the years. Whether you're introducing someone, whether you're showing a piece of data, you have to let the audience know why they care about the person, why they care about the data, why it matters in the grand scheme of things. You have to learn how to roll with the punches. I can't tell you how many times Tim and I have got on a call after a presentation, belly laughing with the ridiculous things that happen to us as we go through these presentations. It doesn't just apply to public speaking. We have to learn, especially we've seen in the market, how much it's changed, to roll with the punches. And then finally, treat others how you want to be treated. I've talked in the past about the tenure of Tim's team of people that want to work with him because he is a good person. He's a great manager. And I think for all of us, we just need to remember to be a kind, nice human. So Tim, let me pass it to you.
Allie, I'm a little verklempt. Thank you. I wish my mom and dad were alive to see that. Ooh, that was very, very sweet. But I'm not letting you go yet, because there's a couple things that I want to reiterate, and then I've got a question for you at the end. Number one, you asked the question, is inventory good or bad? Let's just lay it out and be binary. I think it's good. Number two, the uptick in the respondents that want to buy. Why millennials matter? You nailed it. Because more want to buy. Let's put our eyes on that and figure out more and more ways to make frictionless the potential to buy. And number three, on a little playful event, but nonetheless, if you're a parent, single men have maintained 10% of the market for many, many years. They've been consistent. So parents can feel a little bit better about their sons. They've been consistent. Now, Allie, you brought up the affordability side on food for thought, but let's go right to the last thing you said, recession. And you and I were together last week when we heard about the canaries in the coal mine. Share with us what you're looking at as the canaries in the coal mine that will shift either, yes, it's a recession, or no, it's not.
Yep. And I will say that I think a lot of people, even within the economics department, there was a lot of debate about us saying 60%. There's a lot of people on our team that do think the soft landing is likely. So know that it's kind of a varied take. I did feel a little bit better, not that I want a recession, but at least with us coming out with that. Jamie Dimon came out recently and also put it at 60%. If you look at the Wall Street Journal survey of economists, they put the probability at 40%. So maybe they're more tempered than we are. For canaries in the coal mine, I think the biggest thing, and we've just worked with one of the big builders on this, is tracking out the labor market. It is generally a lagging indicator, but for us, we're starting to see some pretty notable shifts there. We're still tracking manufacturing, which has been down, and it hasn't really caught that recession yet, but we're watching that. But the most important thing, and I think 2 webinars ago, we spent so much time talking about it, is the consumer. We have student loans that have come back in. We have consumers that are defaulting on credit card debt. Inflation level, the price growth is down, but costs are still high. We're just watching how consumers are responding to the backdrop. And I would say they are what give us the most angst about the market.
Beautifully said. And Allie, thank you very much for those kind words. They went straight to my heart. Thank you. All right, ladies and gentlemen, fasten your seatbelts because we're going to dive in. Now, we're going to go into the supply stats, but really think about this element. We have been burning through our communities faster than we can bring them back to the market. And that is an issue, and it's one of the things that is pushing pricing. And as we look at the change from 2019 to many of these markets, look left to right. I mean, if you're in Jacksonville, we're 30% below the community count where we were in 2019. But look at the far right, LA, that's a whole nother story. We'll talk about that in a minute. But Tampa, I mean, Tampa's almost 50% down. So that is a challenge and one that we do worry about because we need that supply. And so important, we need the supply in reasonably priced communities. And we'll talk more about that in a second. Now, when we put starts in context, check this out. When you go from 1 down to 25 for the top markets, this gives you the annualized starts looking at 4Q23 back for a year. And you get a sense for how we've changed year over year. But then let's also overlay a little bit something else. Let's think about what's happened for the change from 2019. And look at the far right-hand side here. And you can see the markets that when we compare to that normalized, quote unquote, time frame that Allie has referenced, look how many of our markets are still down. And these are markets that are relatively good size. I mean, when you're talking about a market the size of Phoenix or a market the size of Austin, those are significant sizes. But let's dive a little deeper. Let's go into kind of a case study because I want to take you back and want to have you compare 2 of the behemoths in terms of population in the United States. And of course, I'm talking about Texas and I'm talking about California. Now, when you look at the right-hand side where population is, California's got, 2+ million people more than Texas has. But Texas is starting 4x plus the number of units that California is. So when you think about it, what is going on? What is the issue? Well, I think basically. The big differences are regulation, immigration, land, and I'll overlay that with a political environment that is not so pro-housing in California as it should be. And I want to also give you perspective. If you go back about 20 years and you look at the activity of starts and closings in California and Florida and Texas, those big 3 states used to account for over 30% of activity. And now California has fallen off. It's not in the running anymore as one of the big behemoths for new production. Now, you know that we always are looking at the lot supply. And of course, more starts means a tighter lot supply. As you look at the way the LSI has moved, the reason it flattened out is that starts picked up. Because remember, it's really a math element that we look at the lots divided by starts. But let's give you a little bit of a perspective on which markets are probably close to balanced all the way to significantly undersupplied. Look at the lower right-hand side, see if you can pick out your market. Look at Las Vegas, which Allie had been talking about earlier. With a 53 ratio, that's generally significantly undersupplied. And we're paying attention to this because the market has changed a lot. Look at back just to, the early part of 2022, when the LSI overall was barely over 30. Now, market-wide, it's over 60, but it's flattening again because the market has picked up. And I've got a couple of comparisons for you. You look at San Antonio at the top, they're probably leveling out, and they are where they need to be for lot supply. But LA, we just can't build what we need. So speaking of those two examples, look at San Antonio. Look at the shift that it's gone from generally, equilibrium to undersupplied to now probably in a place appropriately supplied. Let's compare that to LA. Look at LA and how it's moved. And if you work in LA, all I can say is you're fortunate if you have land. If you don't work in LA, good luck finding the land, because with this kind of LSI, that prices continue to inch up. Now, quick move-ins are the other phrase for what can be considered a four-letter word, and that's standing inventory. But there's a key thing to this element. And when you really think about it, there are builders that are realizing that the pivot to embracing more quick move-ins has been really the panacea for a market that has been undersupplied from the resale side. And look at this quote from Toll Brothers. This is a fantastic perspective. They have the spec strategy. They consider themselves nimble. They used to have 10%. Now they go to 40 to 50% of their product as spec. And look at the last sentence. We are committed to it. And I think that really comes from the standpoint of being a sign of the times, because the for sale side is being ultimately served by the new home side in an increasing basis. Now compare a couple of markets. This is the QMI, quick move-ins, year over year. Now let's look at it from 2019. Now you can see Vegas has gone up, but remember what Ali said about Vegas, because it's been one of the markets that's overperformed for the bugaboo of California. You've got a lot of Californians moving to Vegas, not just for the affordability factor, but also for the lower tax base. With no state income tax, you get an 11 or 12% raise the day you move. Not a bad thing. And also keep in mind, the resale supply in Vegas is exceptionally low. So QMIs fill that hole. Now, when we ask the builders, as you know, monthly, we ask the question about land acquisition strategy. Look at the left-hand side of this. Full steam ahead, and compare that. That's almost 50% of the respondents. Compare that to just July of 22, when interest rates had increased and the market was afraid. And boy, oh boy, we have seen that shift. But I also want you to think of it this way. With that shift to committing to buy more land, look at the land price expectation. Land prices are moving up. And look at the far right-hand side of the graphic where it said land prices are coming down. Well, I think 1% of the audience has said that, which is about 8 to 10 people, possibly 15. And I think that they simply haven't looked at some of the offerings from brokerage houses yet, because land prices are definitely heading up. Now, we continue to watch lot supply, but importantly, we're watching lot supply not just in terms of overall numbers, but in terms of the status of the land. And as you look market by market, the important thing is to look at the far right-hand side of this, and that's where the streets are in. And that is when these lots can come to market immediately. But as you move over to the left side with streets paved and excavation, that's where the lion's share of the product is. And what I mean by that is there's the implication that there could be a little slowdown here in terms of bringing lots to market, which also puts another upward pressure on lot prices. So we're going to continue watching that. But the implication here is that we've got to move from the left to the right. We've got to move from excavation to streets in. Now, one of the biggest questions in the market is what happens to land vintages over time? I mean, think about the land that's been owned for a while at a lower basis, or land that's been owned for a long time that maybe was going to be a zombie lot and there's a potential, or the new product that has to be brought in. And there's a whole series of things that we're thinking about as we go into that. The impact on margins, what it means for home prices. With a higher lot price, you've got a higher home price, and also the land acquisition strategy. Are we going to look for the 4Fs, far, 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 far away, to find land that is less expensive? I think all of those are in play right now. Let's dive a little bit into our housing trends and look at the little blue bar where January and February shows, and that is where we are for the early part of 2024. and it positions us below 2020 and above 2023. And the key thing to pull from this is that the builders are reporting that for the most part, it seems to be that the consumers are responding. And go back to what I pointed out that Ali said and that Ali pointed out about the millennials. There are more that are ready to buy. That's a very, very good indicator of what's to come in the spring selling season. And as you look at this for price increases, notice that the February 24 numbers are the dark blue. Note that they've spiked up a little bit. Just look at the $1,000, $3,000, and $5,000 price increase. They haven't spiked, but they've moved up a little bit. And there's a fewer number of builders that are keeping prices flat. Look at the right-hand side, no price increase. So ultimately, we look at that as a sign of the time simply because we are seeing prices move up, but they're moving up gently for home prices. Now, migration is important to think about. And I want to pause on this so you guys grasp it, and then you'll see that there's variations on a theme for the next couple of slides. Now, what I'm showing you is the count of active detached products offering at least one plan below $350,000. So look at the left-hand side and you see Houston. 27% of the subdivisions had at least one plan under 350, and there were about 300 of those subdivisions where you could find it. Atlanta was 38% with about 285. So then let's just look at it a different way. Look at the percentage only. And Atlanta and Phoenix, they were leaders. And look at the right-hand side of this. And remember, this is going back to 2019. We had a couple of markets like Denver, San Diego, Miami, who had exited the survey as far back as 2019. Now, let's look at it now. And look at Houston and Dallas. Look at those numbers. With Houston, we still have about 230, 240 of the projects that have a product, at least one product at 350. But look at all the markets that have exited the survey. We still have Houston, Atlanta, Chicago, Austin, Dallas. You can see the percentage, but it's getting smushed. It's absolutely getting smushed. And what that means for the market is higher prices, of course. Now, let's look at some of the markets where there's $1 million product. Now, this goes back to 2019. Notice that this time we're focusing in kind of on the high end. And of course, you see LA and Seattle first. And 59% of the projects had at least one product at $1 million plus in LA. So 59% and about 118 projects. And let's look at the percentage. In San Francisco, 75% of the product was at that $1 million place. Pretty significant. Well, what's it like now? Holy cow. Well, let's look at Dallas. Dallas looks like it's way up there, but only 8% of the projects have a community, or excuse me, have a product line at 1 million. Look at the right-hand side. As we move down, Miami's at 51%, LA's at 68%, and you can see it this way maybe a little bit more clearly as we look at the percentages. Now, ultimately, when we think about there's a different story here when we compare certain markets. Now pause and notice, I'm going to compare with you the detached product above $1 million for Dallas and then also for Seattle. So if you look at the line that shows share, so you can see it's, around 8%. And if you look at the bar, it's the absolute number of communities. So you can see it's, around 85. Now let's compare that to Seattle. Well, Seattle, the share is much closer to 50%, 45, 50%. And the number of communities is actually pretty similar. But note, the vast majority of product in Seattle is getting to that $1 million place. So that goes back to the affordability challenge, pull it into the recession discussion that we're having, and the canaries in the coal mine, because we are truly trying to track and find solutions for these biggest challenges. And many of you out there who are home builders, I want to tip my hat to you because you've been doing a terrific job with the pivots. And the pivots have to do with certainly the buy downs to help people have lower interest rates on their mortgage, but perhaps more importantly, cooler and newer product that is detached and attached. Bring the great product. We want to see it and we're happy about it. All right, final thoughts, guys. Couple things. You know that I'm a sucker for a couple of these things. The first one I want to show you is a 12-year-old kid walked out into the snow. Parents couldn't find him, but of course, this canine dog, Bisa, and the officer, David Lundgren, went out into the cold, parts of, I think this is Minneapolis or Massachusetts, and they found this young lady. She was okay, and that is a hero dog. Good puppy. Now, this gentleman, his name is Bill Muzzalewski. He is legally blind, so he can't drive, but he walks every day 5 miles one way to work. Now, that's what my dad used to claim he did, but my dad walked uphill barefoot. Now, this gentleman is recognized in his neighborhood, and over time, the people in his neighborhood have created a thing on Facebook called Mr. Bill's Village. And it's basically an Uber rideshare with the community. They drive him to work when they can. There's some goodness in the people after all, right? And then this poor little guy, this person was turning 4 years old. His name is Cyrus, and Cyrus's mom had all these presents and a whole party planned for his 4th birthday. The car got broken into, all the stuff was stolen. The mother was absolutely, blindsided by this. And what ended up happening? 2 of the officers in the neighborhood went to Walmart, bought a bunch of gifts for the young man. And of course, the gifts centered around Paw Patrol. But see, police can do some pretty wonderful things once in a while as community service officers. A couple of other things to think about. This one is a mind blower. $1 billion donation to the medical school is the Albert Einstein School of Medicine, and it was given by Ruth L. Gottesman. She's the chair of the Einstein Board of Trustees. She put $1 billion into the school. And her quote is, "I'm happy to share with you, starting this August, the Albert Einstein School of Medicine will be tuition free." Next thing. Now, not sure how you feel about me identifying politicians, but when they take action, I got to say something. And this is the mayor of Boston, Michelle Wu. She had been hearing things about issues with public transportations. She actually started to ride public transportation and talking to the people that were on it. The kids that took it to school, the teachers that took it to school. And by doing so, is making some changes with the bus system. I know it's a little thing, but that's what our politicians are for. And speaking of politicians that have it right, Mr. Stubb and Mr. Haavisto were running for president in Finland, and one beat the other. Of course, Mr. Stubb beat Mr. Haavisto. They ran a wonderful campaign, a polite campaign. And at the end, Mr. Stubb thanked Mr. Haavisto for being fair and honest. And when Mr. Stubbs was asked, about this element, he said, I want to uphold peace in this beloved country because I love this country. Holy cow. Is that something we can take home? I think so. So here's our last thing. And it's our last inspiration of the 44 trips we've taken together. And I've had people in here that Allie and I have talked about that have been heroes, that have done wonderful things for others, that have passed away and left an incredible legacy. But here's what I want to acknowledge today. When you think about all the stuff that we have to address with economic trends, supply and demand, pricing, home builder trends, starts and closings, challenges, good news, bad news, and all of the trips that we've taken together, ultimately, we want to say thank you to all of you that have taken this trip with us. You've been our inspiration. It has been an incredible ride with you guys. Please stay with us because we're going to up our game even more so. I know it's going to be ultimately a subscription product, but it'll be worth it. I promise you that. But most of all, on behalf of Zonda, our marketing team, Valerie and Amanda, Ruby and Arthur and Richard, and Allie and me, we really appreciate you guys being with us, and you've inspired us. And I also want to thank our sponsors for being here today, LiftMaster, and of course, our friends at Propane, Energy for Everyone. Thank you guys. It is a wrap, and I hope we're going to see you at our next one. Stay with us. Take care, guys. Have a good day.